Thank you. And hello, everyone. Really great to see you and have you here for this ADP session. A quick reminder to please mute your microphones, and we encourage all participants to share your videos. We'd love to see your faces. As usual, the presenter will have the first 5 minutes of uninterrupted time. After that, you can use the raise hand function, or you can put your question in the chat box. So today we have the lovely Pengguo Wang from University of Exeter, who will be presenting his co-authored work on growth and accrual anomalies. Pengguo, the floor is yours.
Okay. Good morning and good afternoon, everyone. This is basically a topic with my co-author, David Ashton at Bristol University. The main purpose for this paper is to understand a few prominent capital market anomalies. Any comments will be greatly appreciated. Anomaly basically is a piece of evidence, empirical evidence, cannot be explained by existing theory. In this paper, we focus on two anomalies, namely the accrual anomaly and investment anomaly. In a seminal paper, Sloan finds a strong negative relationship between firm level future stock returns and accruals. In contrast, Hirschhofer, Ho, and Toh document an even stronger positive relationship between aggregate accruals and aggregate stock returns. Sloan's research is in cross-sectional and analysis, and Hirschhofer's research is in time series analysis. Like any other capital market anomalies, the accrual anomaly has two different explanations. One is a behavior means pricing-based explanation. The other one is a risk-based explanation. Where a large body of empirical research seems to support Sloan's original explanation on capital market inefficiency, Hirschhofer and others attempted to examine whether accrual represents a type of risk that is not captured by existing risk factors. So unfortunately, to rule out this possibility and to find that even after control for the accrual risk factor, accruals remain highly significant in explaining stock returns. So indeed, this is not easy to explain how a missing risk factor makes accruals both positively and negatively related to future stock returns. So a related body of study document the so-called investment anomaly, documents a negative relationship between various forms of corporate investment and future stock returns. Again, there are two different explanations, mispricing-based and risk-based explanations. In contrast to the vast empirical literature, in this paper, we develop a parsimonious valuation model and show accounting variables such as earnings risk, asset growth, company profitability, book-to-market ratio, and accruals are connected in a complex way in asset pricing. Basically, they are linked in a nonlinear fashion, joined together in valuation. We find the interaction between risk growth and future earnings play a central role in explaining the accrual risk premium and investment anomaly. We believe it provides insights into the structuring of future empirical investigation on empirical puzzles based on accounting information in the future. In the last few days, I've been thinking about how our study can help the accounting design. In my view, with the availability of explosive data accompanied with sophisticated econometric packages, do we have more capital market anomaly related to accounting information? Even in an efficient market, no matter how good accounting design is. So our model suggests that, so if we draw conclusions based on linear regression, you examine the role of accounting information, there is a possibility that we're subject to misuse of accounting information. So if we interpret price to earnings and price to book as a growth proxy, so we may subject to misinterpreting of accounting information. But this is because growth interacts with earnings and book value in a multiplicative form in our model. Therefore, we think about this accounting design issue from a research methodology perspective. So clearly, we're unable to eliminate future anomalies because we know capital market may not be efficient from time to time, but we can improve design of research methodology and better interpret accounting information to reduce some future empirical puzzles. So our model starts from the dividend discount model by rewriting dividends in terms of book value and earnings. This is dividend term, basically. And on the clean surplus relationship, BED, book value, earnings, and dividends. This N is a stochastic discount factor. With the innovation, we assume follow normal distribution with mean zero and variance of sigma n square. This lambda represents the investor's degree of risk aversion. And RF is a risk-free rate. So from equation 2, this basically is the market value of equity. We know the fundamental accounting determinants of equity value is return on equity and evolution of book value. So our assumption follows, we're based on these two variables, basically, return on equity and the growth of book value. Now we assume the scaled earnings or return on equity follow a well-established mean reverting process, combined with the notion that low persistence of accruals in forecasting of future earnings. So we can also rewrite this term, earnings term, in cash flow and accrual. This cash flow CF represents cash flow from operations, and AC represents the total accruals. And this is mu E and mu C, mu A are the expected long-term mean, long-run mean. And this alpha 1 is the speed of convergence. So alpha 1 term is the interaction term, shows the current period accrual related to next period earnings. The low persistence of accrual implies alpha 1 less than 0. If we say accrual's persistence is lower than cash flow, then this alpha 1 must be less than 0. And shocks.
Sorry to interrupt. The question from Stephen.
Actually, the previous slide, you've got expected ROE in the future there. Just a technical point, this should be expected earnings relative to expected book value. It's not, as we know, the same as expected ROE. So just that's.
So we have expectation on the outside here, but this is just generally from dividend. We can rewrite this term. As you can see, this term, if I multiply this BT term to here, this is cancelled. And this is BT term multiplied by this, we get an earnings term. So that's the earnings minus the change in book value. That will be the dividend from equation 1. So this is the dividend, basically.
That's the dividend, but I would say, but I point out ROE is expected earnings relative to book value, right? Which is not the same as expected earnings relative to expected book value.
No,
Yes,
no,
so,
here there's no expectation signed here.
well, it's a T plus tau.
T plus tau just the time T plus tau, the tau from 1 to infinity.
Okay, well, maybe I misunderstand, but I think it's in the future, so it's an expectation. The other thing is on accruals, you've got to keep in mind that the way they define accruals in the accrual anomaly is in terms of the change of balance sheet items. Okay, so they see the change in accounts receivable as being an accrual, but they actually make a mistake because the change in accounts receivable, the debit is an accrual, but the credit is a cash. Okay, so it's actually a mixture of cash flows and accruals. I think you need to sort out what's your definition of accruals, and that may change things because the change in accounts receivable is actually has cash in it, and there's sort of misrepresentation of accruals in the literature.
Okay, so our model basically we just say our accrual basically actually in our empirical part of this paper, we actually follow Sloan's approach to estimate accrual, and then we calculate the difference between earnings and accrual as a cash flow. So this basically in this theoretical piece of work, we just write this this accrual. We say this is just a total accrual.
Okay, well, but you do. I don't think Sloan identifies accruals correctly. If the accruals are change in accounts receivable, we know the debit revenue is accrual. It's a revenue accrual, but the change is also the cash paid. So it's a difference. So it involves cash. It's not a pure accrual. The revenue, the debit is the accrual, not the change in the receivable. So it's a question of what you're modeling. If you're taking the Sloan definition of accrual, I don't think that's pure accrual.
No, this model part, this is just a general definition of accrual. And for the empirical, because here there's nothing related to any empirical item or collecting any data at this stage. This is just a definition. Any item you satisfy this equation with definition, just by definition, earnings equal to cash flow plus accrual, and then we can say if this is a we take this CF as cash flow from operation, then the difference between earnings and cash flow from operations will be accrual. So this is just general definition here.
Well, we can talk about this later, but that's very common that earnings are seen as cash flows plus accruals, but accruals, as defined in Sloan, are actually the revenue minus the cash flow. Okay, and it's the revenue that's the accrual. That is, we recognize revenue under accrual accounting, okay, without any reference to the cash flows. And then there's a difference between that and the cash flows. If the accrual here is actually the change in receivable, then you've got revenue equals cash flow plus the revenue accrual minus the cash flow, which is equal to the revenue. So I'm just pointing this out, that there's a confusion in the literature. The accruals identified, and if you're referring to Sloan's accruals, they're not accruals. They're actually a mixture of accruals and cash flows.
Mm-hmm. Okay, so at this point, we did not refer to anybody's definition of accrual at this point. Up to section 6, when I try to replicate.
Pengguo, if AC is the accrual, okay, and you've got two things. You've got cash flow plus the accrual. Okay, if the accrual is revenue, okay, then it can't be revenue equals revenue plus the cash flow. In that definition, the accrual must be the revenue minus the cash flow. Mm-hmm. And the accrual accounting says you'll recognize revenue without consideration of the cash flow. That's the accrual.
Okay.
Anyway,
okay.
We can talk about this offline. I just want you to be aware of that problem.
Yes.
So the question of what you're trying to characterize, are you trying to characterize the change in receivable? Do this for revenues the change in receivable and calling that accrual, well, you can do that and see what you get out of it. Or do you want to call revenue the accrual?
Because for the model part, actually, this can be any two variables. If they're added together equal to earnings, that would be fine. For the theoretical part, up to section 6 in the paper, that's just we can we can rewrite this x1 and x2. There's no problem for the all this theory part. In this information dynamic, the shocks epsilon E, we have the two components. One is systematic components. The other one is the firm-specific components. We're assuming this firm-specific components also follow a normal distribution with zero mean and variance sigma E square. And the systematic components, we write this KE term. KE bigger than 0 implies basically in a favorable economic condition, and firms with earnings or return on earnings are more likely to bigger than the long run means. So unlike empirical work, we need to make assumption on accruals.
Sorry
so
to interrupt. Yeah. Pengguo, I have kind of a follow-up question related to the slide before. So sorry to interrupt you. So when I read the paper, I really like this equation 3, and also like how you decompose the arrow term into the market component and the idiosyncratic firm specific component. But one thing as a reader, like I would like to see some specific examples. So like related to what Steve talked about, like think about a company mostly generating revenue by collecting cash versus accounts receivable. Or you also have a cool example about long depreciation expense for long-term assets. I would like to see how those different accrual process in terms of durations and the reversal process were related to your alpha 1.1 and 1.2. Like what magnitude do we expect to see if a company primarily collecting cash to generate revenue versus using receivables to collect payments? Just something kind of like as a illustration, that's how those magnitudes correspond to the accrual, different accrual process. Or you can think about companies with only current assets versus another company like construction firms with long run assets, and the depreciation, the useful life will actually correspond to the alpha 1.2, right? In your equation. I just want to see some examples that help me link with.
Can I make an
firms. Yeah.
Sorry.
Okay.
Can I just make a comment here?
Yeah.
In the actual, the mathematics, the sort of the symbols become quite large. Every one of those symbols ought to have an I attached to it, referring to an individual firm or a portfolio. So it should be alpha I11, EIT, BIT minus 1 minus mu IE. Now then we drop the I's because it just looks too cumbersome. So it's fairly general, and we're not suggesting that different firms are going to have different combinations of alpha 1.1s, alpha 1.2s, and even down at the bottom of the slide, it's going to be KEI. It's going to be specific to a particular firm, that some firms follow the market quite closely in a sense, some have, and it would be plus an epsilon E with an I subscript. Some have a lot of unsystematic risk. Now we drop the I subscripts. So in that sense, just to make it the presentation plausible, slightly clearer.
So basically you suggest we should make some example to motivate why we have this information dynamic, right? If I understand correctly.
Yeah, is motivate and also kind of illustrate that how do we use your model, right? This equation, because I think one of the implications from your model is that you want to talk to future empiricists when we actually model the earnings process, we should consider alpha 1, alpha 1, 2, and later you have the other two terms related to growth. But like, it just helped me kind of like think about what would be the next step when I'm going to actually apply this, and how do we validate your model using using the compute stat data. So one related,
in the paper itself, basically, we motivate this information dynamic with the two things. One is a more recent earnings forecasting model have exactly this sort of form. Basically, you say we can use earnings of persistence. We can use accrual. We can use a dividends term, and we can use book value to forecast the next period earnings. We made this point in our one footnote. The other one is we can write, basically from this equation, we can rewrite accrual in terms of future, present, and past earnings term. This is basically just a measurement of earnings quality. We can just rewrite this equation. Just write current accrual in terms of future, present, and past earnings. And we just refer this to different points when we write this, make these assumptions. Okay, your point is well taken. And we assume this scaled accruals follow a joint mean reverting process, which enable us to facilitate independent treatment of risks inherent in accruals. So this epsilon A, this error term, basically also have these two components, systematic component and from specific component. We posit that the high and low accruals need to be defined in terms of deviation from the firm's long-run mean, not cross-section mean. Because most of the empirical paper, they use this cross-section mean in their research. And this is basically is evidenced in the income smoothing literature and the literature accrual-based earnings management. Of course, accounting policy is constrained by the norms of industry sector in which the firm operates. So we argue this is basically is a firm specific long-run mean as mu E mu A. As I said, to derive this asset price model, we also needed to make assumption on evolution of book value. Here we assume the growth of book value follow a log normal distribution. And this growth of book value is also has these two components. One is systematic components and the other one is from specific components. And this KE term basically just captures this core variability of growth with the market. And we also denote this expected return, this delta as a delta bar, as long-run growth. So in order to overcome a potential problem in a terminal valuation, when the growth is bigger than risk-free rate, when we use risk-free rate as discount rate, and we introduce a concept of certainty equivalent growth rate. But basically, this is the book value growth rate adjusted by market risk. So we denote this delta CE. This is just called this certainty equivalent growth rate. We can then calculate the difference between this long-run growth rate and this certainty equivalent growth rate as the risk premium. And this is quite important concept. I'll explain shortly. And because our purpose is to establish a relationship between stock return and earnings components, So we also assume that the correlation risk between the error terms in this information dynamic, book value, earnings, and accrual, and the stochastic discount factor are all time invariant. This basically is consistent with the time invariant beta, as is normally assumed in standard estimation of the factor beta in factor model.
Pengguo, you have 2 more questions from Young and then Steve.
Sure.
Pengguo, my question related to your earlier comment on the identifying abnormal, kind of like abnormally high or low accrual. We should use the time series kind of long run mean levels. Have you seen any papers, or has your appendix kind of like tried to show us that once we change the benchmark to the firm level long run average, the high or low accrual firms are very different compared to the cross-sectional sorting? It would be kind of interesting to kind of inform the earnings quality literature that once we change this benchmark to the firm level long run average, previously identified high or low quality earnings firms actually right now has a very different rank.
Yeah,
right?
I agree. Not too much in the literature, existing literature, because primary reason I think is most firm they don't have more than 20 years observation in computer start. As I believe that is the major reason why people use cross-sectional analysis in this area rather than time series firm by firm.
Yeah.
We did try this in our appendix. Appendix basically this we have this sample which shows in the firms with 10 observations, and, and then we calculate what's this long run mean mu e mu a, and what's this this persistence of alpha 21 alpha 22. We have run this we call it assembly unrelated correlation regressions. We do have get this estimation for this mu e mu a in our appendix.
Yeah, I would love to see the appendix. Thank you.
Yeah. Thanks.
Pengguo,
you have...
Yes, your equation there for the evolution of book values. Okay, this I forget where it was. Maybe it's the next page. But book values depend on payout too, right? So if you have high payout, there's going to be no growth in book values. In fact, we have a number of firms now that have negative book values because of just big stock repurchases. So you've got to be very clear about this. This is, you've got something that's violating M&M here. This needs to become dividend book values to correct that, unless you have an M&M friction.
Right. So you say
the book values decline if you pay out dividends. You look at a lot of firms that they're just getting negative book values now because they're paying out. They've got stock repurchases. Their book values decline just because of payout, even though they have strong earnings growth. That is, it's earnings that give you the growth, and you only get growth in book value from growth in earnings, and dividends upset that. Take it the other way.
okay. So basically, if we have this as a log normal distribution, basically we can write this growth rate is actually equal approximate equal to 1 plus this term, and whether this term can accommodate a negative value, I think is okay, because we assume this epsilon m and epsilon delta for the normal distribution. This can be negative value, so it's not necessarily this growth rate is always positive.
I understand that. So you're actually building the dividends into the parameter. We like to think of parameters being the economics rather than the dividend irrelevant aspect. Okay, so you're actually building that. The parameter is subject to dividend payout. Okay, we typically don't like that. We like to recognize sort of the economics.
Right. Okay, I make a note here. You say basically this whether this is consistent with MM.
We'll just call the book value plus come dividend book value.
Okay, so the replacement. Thank you, Stephen.
If firms pay out a lot of stock repurchases, the shareholders just take it and buy more book value by actually reinvesting in the firm or investing in other firms with book value. They just buy more book value.
Okay. Let's think about that. Okay, so based on our assumptions, we can write market value of equity in terms of this accounting fundamentals. Basically, we say the balance sheet item and income statement item are jointly in action. And we know this earnings and book value, they are in a multiplicable form rather than just a linear form. And if you look closely, the first term, this mu e minus this growth and the book value, we know the mu e is basically the long run mean of a return on equity. So the first term basically is the dividend, long run dividend. So the first term basically captures the risk neutral present value of long run dividends. And if this value of equity anchored on this present value of dividends, then this two deviation term, scaled earnings relative to their long run mean and scaled accrual relative to their long run mean, will make an adjustment to this valuation, because we assume all these accounting variables as growth with a certain equivalent growth rate. Certainly we have to add some abnormal growth component. That will be this growth adjustment, which is a function of market volatility and the correlation between earnings and investment and accrual and the investment. And because our valuation has been done in a risk neutral world, because we use the risk-free rate as a discount rate everywhere, so we have to adjust this earnings risk. Here, so actually we use the correlation between earnings and the market. This is quite consistent with private literature, like Stephen, your work and Ian's work. Basically, this we use actually earnings change rather than stock return to estimate firm specific this firm systematic risk.
Hi, Pengguo. Before you move on, I just have a question related to your previous slide. In the paper, you mentioned that you have this proposition 1. So the second term beta 1 has earnings, right? And the earnings previously you defined it as the sum of cash flow and accrual. And then the third term is accrual itself. And in the paper, you mentioned that the third term accrual actually has incremental role in explaining book market value of equity, which is the left-hand side of the equation. But my question is that this ET, the second term, already is the sum of accrual and cash flow. So I just struggle with that. What's the incremental role or information coming from the third term?
Oh, right here. Right. Yeah. Basically, if this alpha 1, 2 is everything, you say, this beta 2 is related to alpha 1, 2. Alpha 1, 2, if you look at where's this alpha 1, 2 from, this is basically just the incremental role for forecasting future earnings. You say if cash flow and accrual have the similar persistence in forecasting future earnings, then alpha 1, 2 equals 0. Because we know accrual is useful for forecasting future earnings, this alpha 1, 2 is not equal to 0. In fact, because accrual is less persistent, we know this alpha 1, 2 is less than 0. So it's not equal to 0. That's why we have this incremental components in the equity valuation.
Thank you. So that captures the differential persistence that the accrual has compared to the cash flow. Okay.
That's right.
Thank you.
So based on this equity valuation model, we can write our expected return in a Kaplan style asset price model, because this is a accounting-based asset price model, which just shows this excess return can be written in this related to this two risk premium term. This ERP is earnings risk premium. It's basically is attributable to earnings risk priced by the market. And in the common days, the risk inherited in cash flow and accrual. And the second risk premium is we call this gross risk premium. This gross risk premium is distinct from this earnings risk premium, but they interact with earnings risk premium. If you look at the second term in the gross risk premium, as you can see, because this book value can be considered with this book value, so we will have this future earnings yield, forward earnings yield. As you can see, if any variable can be used to forecast earnings yield, it will have a negative sign attached to this gross risk premium. So this basically is some evidence we can say from so-called this investment anomaly. But why this is the case, we need to further decompose this earnings gross risk, earnings risk premium. So we can decompose this gross risk premium into these three elements. The first element is basically this term. So this term is equivalent to this, we can just rewrite this term into this risk-related term, which is captures the covariability of growth or of asset growth with the market. This is the K delta term. We'll define K delta, we'll have this term. The second term is this term. This is the expected stock return on the goodwill proportion of market value. The goodwill basically is the difference between the market value of equity and the book value of equity. And the third term is market value scaled economic profit or abnormal earnings, because this is accounting rate of return, this is market rate of return. So the difference between these two is economic spread. Multiplied by the opening book value, we will have this economic profit or abnormal return term. So I think this is quite intuitive. We decompose this gross risk premium in these three terms. And this has an important implication to explain why we have this so-called investment anomaly. Just to focus on this difference, economic accounting rate of return and economic return. Now, if return on equity is bigger than the cost of capital, we know from valuation theory, higher growth will increase firm value. We can say this, we know this from Stephen's book, Check's book. So investors will require lower gross risk premium, and hence a lower return for higher growth firm. On the other hand, if return on equity is lower than the cost of capital, the higher growth firm will destroy firm value. So investors will require higher gross risk premium, hence a higher return for higher growth firm. So that's just to discuss in detail this decomposition of these terms. Therefore, the coefficient attached to a growth proxy that is positively related to future earnings in cross-section regressions of stock returns is expected to be negative because of this negative sign here. And since in the economic spread, when this term, in this scenario, basically, when it is expected to hold for the majority of a company in the market in a normal year, this is the scenario, I think, in general case. So that's why we call this investment anomaly. So from this decomposition, we can explain why we observe the so-called investment anomaly.
So Pengguo, I have a related question. So have you kind of tried to estimate the 3 different components
No,
using archive data? Because it's fascinating to know that how big those relative magnitudes are, right? The first one is kind of pretty much the stochastic market-wide growth, right? The second, I think I would not limit it to just goodwill, but anything intangible assets or intellectual property that are expensed in the income statement will be captured by your second term. And then the third term is kind of like understanding whether the internal corporate investment decisions actually is an NPV positive and negative projects. So I will be curious to see whether we are able to estimate it and using your framework and then see the magnitude from the archival
okay, very good point.
data.
Thank you.
Yeah.
I'll try, yes. Haven't done that. So we can rewrite our stock return in terms of a characteristic model in order to explain the relationship between our return expression and the factor models. Here, as you can see, we know this assets growth and return on equity and book to market, they are connected in a nonlinear form. So if we take expectation, of course, we will have this additional this covariance term, which is here. So we know the empirical limitation of the capital assets price model is augmented by accounting fundamentals to generate multi-factor models. The factor models are linear, but in contrast, our model is nonlinear, and these factors, as I said, return on equity, book to market, and growth are in a multiplicative form. So this is one of the big difference. Our model, factor model, and our model include this book to market, this factor, but we have different interpretation. But when they're in the literature, book to market or market to book is explained as a proxy of growth or profitability. But in our paper, book to market appears as a pervasive multiplier of other factors, because as you can see, book to market, this ratio everywhere. And it serves as a convenient proxy for capturing the firm's specific conservative nature of accounting. It's basically effectively the converse of units of accounting dollars, earnings or book value, into monetary dollars or price. And with the board 2020 paper, they say why book to market predicts stock return, because book to market is subsumed by return earnings to market. And the latter is a better proxy for future earnings yield. But in our model, our book to market converts return on equity to earnings yield. Just like we can say from this expression. Our book to market basically converts this return on equity to future earnings yield, as same as their argument. But in addition, our book to market occurs naturally as a convenient summary of accumulated transactions. So that's different. And the third difference with this factor model is, we know Herschel's paper, as introduced in the slide 1, the slide 2, basically, very beginning. And their accrual factor is created based on accrual. But in our model, we should say the deviation rather than accrual represents risk associated with future growth. Because as you can see everywhere, we have this deviation rather than accrual per se. So why accrual can be used to explain stock return? But from our model, we can say this is because growth, asset growth, is linked to future earnings, and accrual is useful for forecasting future earnings when cash flow and accrual have different degree of persistence. As you can see from our expression, just like this. Because this growth, asset growth, is interactive with future earnings or earnings yield. So, but accrual is also, we know, useful for forecasting future earnings. So that's why accrual can be used to explain future earnings. So the apparently contradictory signs in cross-sectional analysis and time series analysis suggest that the regression of return on accrual without incorporating this growth risk constitutes a correlated omitted variable problem. This is a central result. Then we can have a closer look of Sloan's research and Herschel's research. Sloan's original research analyzed firm-level relationship in the cross-sectional analysis. Basically, in his research, risk growth is omitted correlated variable, or you can say that he treated this growth as if it is independent of earnings. So, based on this hypothesis, then we can rewrite our equation 10. This equation 10 in simplified form, because here there will be this delta will be a constant in cross-sectional analysis. So we can rewrite, simplify to this form. And so our interest, as much of existing literature, is with the sign of this accrual term. So this term is as I highlighted in red. So we can replicate Sloan's research based on our theoretical model. We find our results support Sloan's result. This coefficient in average indeed is part negative. In fact, the predicted coefficient is less than 0 for 55 out of the 56 years over our sample period between 1963 to 2019. And we also find the magnitude of accrual coefficients are noticeably smaller over more recent period, which supports evidence in green. And how our research related explain Herschel's result. We know Herschel analyzed the aggregate relationship in the time series analysis. In time series relationship, this growth term is stochastic, as potentially related with aggregate accruals and aggregate cash flows at time t. So in their simple univariate regression, they implicitly treat growth as if they were independent of accrual and cash flows. And then if we, to replicate their work, actually we only need to estimate this term. This is based on our equation 10. The correlation between our deviation of accrual and with market return. This basically is the regression coefficient. So we calculate this term, we get this is positive number. This is support their result, but it doesn't explain why this is positive. Why in the time series analysis and the return is positively related to this aggregate accrual. So to find out the underlying reason and to validate our model, and we also need to estimate the correlation between each item, each terms on the right-hand side of equation 10 with this deviation of accrual. This is a much more complicated term, because to validate our model, we have to estimate each of the right-hand term, the correlation with this deviation of accrual. And then we find the consistency. On the right-hand side, actually you found right-hand side value equal to 0.46, quite close to this left-hand side value. And more importantly, we say this two term, the red, we calculate this red term is equal to 0.244 and the blue term equal to 0.216. This two term added together is quite close to the right-hand side value. In other words, all other terms can be ignored and negligible. So this has important implication. So why this return is positively related to accrual in aggregate term? Because future growth and associated dividends and are positively related to aggregate accrual, because that is our evidence shows this result. This is a correlation between growth and accrual, and this is associated dividends with the accrual term. And we also know Herschel subsequently they examine whether accrual represent a type of risk that is not captured by non-risk factors. So the follow from a French 1993 constructed a long-short factor mimicking portfolio to measure the accrual risk to proxy for the underlying this unknown risk factor. The problem arises because they use a scaled accrual rather than deviation of accrual as a basis of classification of higher lower accrual firms. You have a question?
Sorry, I have a question about the previous slide.
Which one?
I think, yeah, this one. So I don't know about the audience. I'm a little bit lost in all those kind of symbols. So I just want to confirm that the red term is the future growth, right? So like going back to the growth risk premium, there are three different components, right? Is the first term that the red term relates to the market-wide growth, stochastic growth. That's the 0.244 estimate refers to, or is actually not related to what we talked about previously about the growth?
This delta t plus 1 is here. It's just basically
just
the total growth of book value.
Okay, so why is this term is so positive and significant in the aggregate time series regression, but actually somehow didn't show up in the Sloan's type of the cross-sectional analysis? This
basically in the cross-sectional analysis, every firm, the time is constant for every firm. Mm-hmm. And they take, this as I said before, you just regard this is unrelated to earnings and accrual term. So that's why we can write this delta tiered to this delta bar as a constant value. But otherwise, we will have this delta t term, right? It's a stochastic. But in the cross-sectional, we treat this as independent of earnings, independent of accruals. So that's why we have this delta bar term as constant. Did not consider this correlation. So that's why we say this is omitted correlated variable here in their analysis.
Thank you.
Pengguo, just an FYI, you have 5 minutes.
Okay, that's great. Yeah, I think it's okay. So our model, if you look at our model, basically our model suggests that the portfolio should be based on the deviation of accrual from the long run means rather than the accrual itself, like what has done in Herschel's paper. So when we constructed the higher minus lower return portfolio based on the deviation rather than the accrual itself, we find both accruals and the long run means can be useful in explaining stock returns. That is exactly what Herschel found. So they show both accrual and accrual factor can be used to explain future returns. Okay, so this is the last slide basically. So we develop analytical model to connect stock returns to its accounting fundamentals. And we explain this accrual normally and investment normally. The most important thing is we find growth interacts with the future earnings, and book value is actually earnings yield and the book to market ratio. But this is something, and in the existing peerage, they just omit this correlation. This is we say this is a big problem. And this paper also casts light on several related theoretic constructs, including the differential risk of components of earnings and the concept of certain equivalent growth rate. We also clarified the role of book to market. Okay, so the last slide. Thank you very much. And just remember, next event will be on March the 9th. Also the 3 to 4 p.m. Eastern time. That will be in the UK, will be 8 to 9 o'clock in the evening. Okay, and Marvel Kubik will present his paper, Does Inflation Affect Value Relevance? Thank you.
Thank you, Pengguo. Thank you again, Ian and Steve. And thank you all for your attendance. We'll see you March 9th.
Thank you.